Imagine, if you will, like a room full of Wall Street private equity managers, or maybe a high-rise office in Mumbai's Bandra Kurla complex. They are just salivating over a financial projection spreadsheet.
Oh, yeah. The classic investor war room.
Right. And what are they looking at? You'd think, well, it's probably the underlying code for a revolutionary artificial intelligence model, or, I don't know, a pitch for a hyper-advanced solid-state battery plant. But it's not.
No, not at all.
Yeah.
It's actually something much more mundane.
Exactly. It is a non-refundable 2 lakh rupee admission fee for a first grader multiplied by 1,000.
Yeah.
Today, we are looking at how the neighborhood blackboard became, quite literally, a multi-billion-dollar financial fortress. I mean, welcome to another custom-tailored deep dive. We are so glad you're joining us for this one.
It is a phenomenal, almost jarring pivot to witness, honestly. We're looking at a structural shift in the global investment playbook here.
Right.
The smartest, most aggressive pools of capital on the planet are actively, pivoting away from the cloud.
Yeah.
They are moving away from the digital frontier.
Which is crazy to think about, given the last 10 years.
Right. But they are deploying these astronomical sums of money into the physical, traditional Indian schoolyard. And it's a direct reflection of our post-pandemic economy.
Okay, let's unpack this. Because the mission for this deep dive is to uncover the hidden economic engines behind these premium schools.
Yeah, we really need to look under the hood.
Exactly. We are going to figure out how and why some of the largest investment funds on Earth are treating like school uniforms, daily bus routes, and quarterly report cards as the ultimate recession-proof cash flow generators.
Because that is exactly what they're doing.
Yeah.
It reveals what institutional investors value most right now in a highly volatile world.
So to do that, I want to jump straight into the numbers from our sources, because they are genuinely staggering. I mean, just this past week, we saw 2 massive deals in the Indian business landscape that perfectly illustrate this exact trend.
And these were not small, under-the-radar acquisitions.
Not at all. First, Vitruvian Partners stepped in and acquired Peak XV's stake in a company called K-12 Techno.
Right, for those who don't know, that is the corporate entity operating Orchid's international schools and Sparklebox.
Yeah, and that deal valued the entire business at around 7,200 crore.
A valuation that, honestly, not too long ago, would have been exclusively reserved for a technology company monopolizing a massive digital market.
Totally. And it didn't stop there. Like, immediately following that headline, KKR-backed Lighthouse acquired Pathways Gurgaon.
Ah, yes.
That single deal was valued at 1,500 crore. Now, wait, I have to challenge this premise right out of the gate, because when I see numbers like 7,200 crore and 1,500 crore, I'm immediately thinking, tech unicorn.
Of course. That's the conditioning we all have.
Right. I'm thinking of software as a service companies with 90% gross margins and like 0 marginal costs.
Okay.
Companies that can acquire 1 million users in a single weekend.
Yeah, the hypergrowth model.
But we're talking about brick and mortar schools here. You cannot infinitely scale a physical classroom. Like, how does a valuation like that make any sense for an asset bounded by actual physical walls?
It's a really valid question.
And more importantly, private equity firms operate on a standard, 5 to 7 year exit horizon. You can't just 10x a physical school's revenue in 5 years without sparking a parental riot or, triggering some sort of massive government intervention.
Definitely not. The government would step in immediately.
So what is the game plan here? Are they just hoping to pass this hot potato to another slightly larger fund in 2030? Like, how does the math work?
Well, what's fascinating here is that you are applying the tech growth framework to a fundamentally different asset class.
Okay.
The global investors writing these multi-thousand core checks, they couldn't care less about exponential user growth or going viral anymore. That era is, it's fading.
So they aren't looking for the next Facebook or Swiggy.
Exactly. Private equity firms aren't acting as charity houses for Indian education, obviously, but they also aren't looking for that insane hypergrowth. They are hunting for one specific, increasingly rare commodity in today's macroeconomic climate.
Which is?
Reliable, highly visible, compounding cash flows.
Predictability.
Right. And you're right to question the exit strategy. The strategy isn't to 10x the revenue in 5 years through explosive expansion. It's to optimize the margins, consolidate fragmented micro markets.
What the PE guys call a roll-up strategy, right?
Exactly, a roll-up strategy. They want to create an asset so structurally sound that, yes, a massive sovereign wealth fund or a massive pension fund will happily buy it in 7 years just to clip the reliable yield.
Wow. So they are treating it almost like municipal infrastructure, like a toll road, but for education.
That is the perfect analogy. It really is. For decades, the broader business world perceived schools as these sleepy, community-oriented projects.
Yeah, like run by a local trust or something.
Right. Local trusts, affluent families, maybe religious organizations. They were viewed primarily as a public good. Maybe they generated a surplus, but they were not optimized for yield.
They weren't ruthless businesses.
No. But this data reveals that premium schools have quietly transitioned. They are no longer community projects. To private equity, they are now arguably the most attractive premium consumer business in the entire country.
Okay, calling a place where 7-year-olds learn long division a premium consumer business feels incredibly dystopian, I'm not going to lie.
I mean, it is a bit jarring when you put it like that.
It really is. But when you look at the underlying mechanics outlined in our sources, it makes terrifyingly perfect sense. And this brings us to what the data highlights as the absolute holy grail of this business model.
Right, the concept of inelastic demand.
Yes, I want to dig into the mechanics of that because it's not just a theoretical economic concept. There is a deep psychological friction at play here for the parents, right?
Absolutely. This is the core economic engine justifying those multi-crore valuations. Inelastic demand, at its core, means that when the price of a service goes up, the consumer's demand for it doesn't fundamentally drop.
Even if it hurts financially.
Exactly. But education isn't just inelastic. The sources refer to it specifically as the last expense cut phenomenon.
Right, and think about what that means for a family. Say a family is facing a sudden, severe economic downturn. Maybe inflation is ravaging their purchasing power, or a primary earner's job is at risk. Budgets are suffocating. What do they cut first?
Usually discretionary spending.
Exactly. The delayed smartphone upgrade. The European summer holiday turns into a weekend trip locally. The fine dining stops. But they will compromise on almost every single other lifestyle expense before they even entertain the thought of pulling their child out of a premium school to save money.
Because the perceived cost of that downgrade isn't financial, it's generational.
Oh, that's a heavy way to put it, but it's true.
Parents view that premium education as the foundational bedrock of their child's future trajectory. To pull them out feels like a profound personal failure. It induces a guilt so intense that families will gladly absorb annual fee hikes of 10, 12, or even 15%.
They just reallocate capital from other parts of their life to feed the school fee.
Precisely. For a private equity fund looking for a safe harbor during a volatile economic cycle, a consumer base that actively subsidizes your revenue at the expense of their own lifestyle is, well, it's the ultimate dream.
And contrast this with the digital businesses we were just talking about earlier. Look at a food delivery app or an e-commerce platform. Those companies bleed capital every single month just to remind their users they exist.
Oh, the marketing spend is astronomical.
Yeah, they're constantly throwing discount codes at you, buying up digital billboard space, subsidizing your delivery fees. Their customer acquisition cost is just a constant hemorrhage.
And their churn rate, the speed at which customers abandon them for a competitor offering a slightly better discount, is practically fatal sometimes.
Right. If Zomato is 10 rupees more expensive than Swiggy today, I'm switching. There's zero loyalty. But a school, this isn't just a subscription service. It's effectively a 15-year corporate bond where the parent is the one paying the yield.
That's a really sharp way to look at it.
And they willingly accept a massive penalty hike every single year just to keep the bond active. Our sources point out that a single successful admission at a premium school in kindergarten translates effortlessly into 10 to 15 years of highly recurring revenue.
And we have to explain how that stickiness is actively enforced, because it's not just